I want pretty much contradict a couple of things that have been said before. I would like to start with how much we all have in common. I've been to billions of conferences of value investors, and we have so much in common. We like each other, we feel so comfortable, but things are changing. And I would like to explain that Lollapalooza is happening, as Charlie Munger has predicted, and it will change the way we invest. And I'd like to say that the new world of investing is here. This is my thought outline for today. I have 19 charts, and I hope to be done around 11:25, so we have maybe 5 minutes for questions. These are our mental heroes. On the very left, Benjamin Graham, who basically invented the field of scientific investing, because at the time he wrote his famous book, the Security Exchange Commission came into place, the Securities Exchange Act and the Securities Act. So publications were available to make conclusions, to do analyses. Warren Buffett, my mental guidance for many, many years. I wrote a letter to him in 1990 and 1991. Can I get the annual reports? And he sent a letter back, sent me $20. I sent $20 and I got 20 years of annual reports. And when I had read those 20 years of annual reports, I understood that Warren Buffett is right and the efficient market theory is not. That was my big conversion. And of course, our mental guide is also Charlie Munger, whom I admire a great deal, even more than Warren Buffett. He's much more open in his thinking, much more socially oriented, much less money oriented than Buffett, a great personality. And we have so much in common as we sit here. All friendly people, always looking for bargains. Is this a cheap hotel? Can we get something cheap? How do we get to the airport? You know, always looking for a good price. That's what connects us. We all want to have financial success. Nobody wants to stay poor. We like to have the reward, financial rewards. And we love modest CEOs who drive cheap cars and have cheap office furniture. And we love happy anecdotes about happy customers and their lifelong loyalties to a brand and why this brand will last forever. And we all believe that good business models will also last forever. And of course, one of our guiding principles, things revert to their mean. Something is cheap, it will come back. Something is expensive, it will come down. And we are all contrarians, except if we are together, we are not contrarians, because we like to follow our own crowd, our own thinking, and feel comfortable in this setting. And in this setting, we are not contrarians anymore. But does anybody know this conference room? Stericycle? Okay. And you remember probably these little tapes, don't you?
I've never been in the room.
Okay, but this conference room is famous. I went there a couple of, maybe 3-4 years ago, and Stericycle is a company that makes basically hospital supplies and the recycling, and which is a specialized field of business. And then you look at this table, and you see how broken it is and little green patches. And yes, of course, everybody goes in the room and says, oh, this is the thrifty company. They really take care of the money of their investors, and what a wonderful company. And then you meet another investor a couple of months later, said, do you remember that conference room? And you see that they develop an anecdote. They want us to fall in love with this anecdote about the company. They distract us. People play with us. People play with our perceptions, and because we all love a good story, we fall into this trap very easily. So, we are all friendly people, but Buffett is not a humanitarian. People misunderstand that. Just because he seems to be friendly, he still is a tough guy. And a friend of mine is in reinsurance or insurance, and she says, don't do any deals with Ajit Jain. He's cruelly tough in his conditions. He's not a nice person. And Warren Buffett is not a nice person. Once you have agreed to a deal, he sticks to it, and you cannot renegotiate anything afterwards. He seems friendly, he wants to be loved, but I don't know how nice it is to be one of his employees. He's really cost conscious. I talked to Chuck Huggins a couple of years ago. Chuck Huggins is the guy who ran See's Candy for about 30, 40 years, and says Buffett wants to know about every piece of equipment, you know. a machine for 100,000, Buffett wants to know about it, and does it pay for itself? He's really into the details, and if you're not reliable to him, you're out. We are all bargain hunters, but some outstanding companies are always expensive. One of the biggest mistakes I made in 1999, I think, I sold Cognizant. I bought Cognizant, a spin-off from, I don't know. It was a spin-off, and I just sold it because it was becoming too expensive. If I just had kept this one stock, I wouldn't have needed to work anymore, because this stock went up, I don't know, a couple of 10,000 percentage points. I just wanted, it became too expensive. I said, now you have to buy something cheap. A huge mistake to leave companies, even if they become too expensive. We all love modest CEOs, but actually I prefer rich CEOs, as long as they align their fortunes with mine. If they have the same interest, let them be rich. I don't care if they just help me become richer myself. And we love anecdotes about happy customers and their lifelong loyalties, but if you look at yourself, how long is your affection for your Palm Pilot, your Walkman, or your iPod? How long does it last? A couple of years, and then the next thing comes along. We don't have lifelong loyalties anymore. We believe things revert to the mean, but some companies don't, like Sears, for example, which simply has been in terminal decline. Some companies simply go down the drain and stay there and will never come back. And with mean reversion, that doesn't work anymore. I hope there's nobody from Deutsche Bank here, but when will Deutsche Bank ever become its former glorious self? Okay, maybe 2 decades out, but definitely not the next 5 or 10 years. And if you have the price-to-book ratio of 25% price-to-book, I think it will take a long time until it comes back to book value. And we all believe that good business models last a lifetime, but some perish after 5 years or so. Very good business model until the next business model comes along. And then let's look at Warren Buffett. Yes, Berkshire Hathaway has been a good investment, but some technology stocks would have had much greater returns than Warren Buffett. We just heard about Amazon and Netflix, etc. If Buffett had invested with his good friend Bill Gates into Microsoft, if Buffett had invested with Google when he got the prospectus to read it and comment, he would have become richer. If Buffett had invested into Amazon when he noticed how tough the competition from Amazon is in his business field, he would have become much richer. So good investment, solid investment, but not the best investment. And moats can disappear very fast. That's the job of Morningstar, to measure moats. There is no safe haven anywhere in the world anymore, even in real estate. We talked about how technology is changing the shape of the logistics in warehousing. Cities change because of technology. Even real estate is not safe anymore. Technology is becoming more important. The lifespan of companies is shrinking. The average age of companies in the S&P 500 is decreasing rapidly. These are now 15-year-old companies. They used to be 60-year-old companies. So the turnover is much, much faster. And it's a winner-takes-all world. You all remember the ABBA song. And it's so much easier to make money by picking one winner than picking 5 mean-reverting average companies. Buffett says, why should I jump 6 feet if I can do 6 times 30? 6 times one foot. Why take the big jump instead of many small ones? Why not take the easy companies that do the work for us instead of doing all the heavy analytical lifting to find those companies where the story tells us that it will be mean reverting in 3 years? Why not do the easy stuff? Buffett did it actually when he did his investments in Amazon, in Geico. These were all fast-growing companies when he bought them. He was a growth investor at his time. And let me quote, we talked about Geico and Progressive last night. And this was the question that came up at the shareholder meeting in Omaha this year. The question was, Progressive is gaining the most market share among the major auto insurance. How does Geico plan on responding to competition? And Buffett said, Progressive is a very well-run business. That's the competitor in the auto market. Geico is a very well-run business, and I think they will last for a long time. There are two companies that the rest of the auto insurance industry has trouble not losing share to, Progressive and Geico. And then Ajit Jain said, the underwriting profit is a function of two major variables. One is the expense ratio and the other one is the loss ratio. Geico has a big advantage over Progressive when it comes to expenses. They are cheap. They are 7 percentage points cheaper than Progressive. On the other hand, Progressive does a much better job than Geico does. They have a 12% advantage in underwriting, but much better in taking risks. And overall, this results that Progressive is 5 points ahead of Geico through technology, by not being thrifty, by spending money on technology and changing the business in a very disruptive way. Let's look at them side by side, very similar. Geico founded 1927, Progressive 37, number 2 and 3 in the automotive market, almost comparable market share, 17 million policies, 18 million policies, same size in premiums. Progressive, a slightly slower growth rate, but the combined ratio, which covers the risk-taking, is declining at Progressive, whereas it's stable at Geico. They use technology to change the business for Geico. And I remember the Geico discussion at the shareholder meetings, and Geico, yeah, we don't need technology. We have our ways of doing things, and it works well, and it is cheap, but Progressive is gaining. And the reason, and this is a chart from a Progressive presentation, the risk distribution of their drivers in the commercial field and the passenger field. And you see there are good drivers and bad drivers. And Progressive has little tracking devices in the cars to see, are you a good driver or a bad driver? And if you're a good driver, you get a much better rate. And just imagine, if you know who the good drivers are and give them a better rate, you get the market share. And you leave these to Geico, the bad ones, because Geico doesn't have the tools to identify them, which means it's one thing to be cheap, another thing to use technology to gain a pricing advantage and to gain a competitive advantage in finding the right drivers. Another example, we all love brick and mortar. We are staying at a hotel, and I want to compare Marriott hotels. We would always say Marriott is a well-run chain and good business principles, and people will always stay in hotels. It's a safe business. And they're in operation now for 92 years. They have 1.1 million rooms under contract. And then we have Booking.com, which is 20 years old, basically a Dutch company, and they have now 5 million rooms under management. Much younger, much more rooms under management. Now, in terms of sales, this is Marriott, and this is Booking. Booking hasn't caught up with Marriott in sales, but look at the profit side. This is EBIT of Booking.com and the EBIT of Marriott. They've overtaken Marriott in about 7 years ago, become just more profitable with a new business approach. Although the two business models seem to be the same, they're both selling rooms, except the one does it much more profitably than the other one. So you can say Marriott is a wonderful company, will always be a wonderful company, but there are more wonderful companies around. Value investing, let me just put this into perspective. Of course, we are all investors. We are not speculators. We like to keep stocks for a long time, and this is investing. And investing, you have value investing and you have growth investing. And value investing is pessimistic in its assumptions. Things will go wrong. There's always risk. There's always competition. You are very conservative in your valuation assumptions. In growth, you're optimistic. You say growth rates will continue for a couple of years, margins will increase, and that's the basic difference between the two types of investing. What is dead is ratio-based investing. Ratio-based is a good price-earnings ratio, a good price-to-book ratio will always work. These numbers have become meaningless, as Warren Buffett himself has said. What is the book value for McDonald's if it's negative? How do you do a calculation? It doesn't make sense anymore. What is the price-earnings ratio if it becomes completely distorted by revaluations in the portfolio? As we've seen in Buffett's quarterly report, it goes up 25 billion, goes down 25 billion. It has become meaningless, basically. So ratio-based investing doesn't work anymore. It's been arbitraged away. And the question is, how optimistic or pessimistic should we be in our assumptions in our valuation models? And in the last couple of years, I've become more optimistic because I see companies that just simply grow like crazy and have margins that higher and higher and higher over time. Warren Buffett says value and growth are Siamese twins, joined at the hip, and he defended the Apple decision and the Amazon decision. And my approach is go where the company will be in 5 years or 10 years. Don't look at it where it is now. What will the world look like in 5 or 10 years? And if we talk about metering in the UK, yes, of course, everybody will have a smart meter. It's obvious, isn't it? Let's not look at the company where it is today. Look at where it will be in 5 or 10 years. Then, as Charlie Munger said, keep learning throughout your lifetime. And I'm a bit angry at Buffett because he says, this is outside of my circle of competence. Well, expand your circle of competence. If that is the problem, learn about the new industries and change. Why should it be static? The world is changing, and please, Warren Buffett, adapt to a changing world. And as Charlie Munger said, Lollapalooza can happen when some things happen at the same time, and I have it on this picture. We have huge changes in our world. I think it's the most dynamic phase in world history that we are currently having. On the left side, we have technological breakthroughs like artificial intelligence, CRISPR and gene editing. We have huge cost and efficiency gains through computing, data storage, etc., through the cloud. We have huge volumes now in terms of people, 2.5 billion customers. I mean, this is a number that's unimaginable 10 years ago for Facebook. I think Google has 6 or 7 business lines with more than 1 billion clients. These are incredibly huge numbers. And if this comes together, the world changes dramatically. I always think of Tesla. I don't like Tesla a lot, but they have more than 100,000 cars on the road. If they drive more than 10,000 kilometers every year, you have a couple of billion kilometers in experience in self-driving. Who else has it? The huge numbers add up. They're always sent back to headquarters. They analyze them, introduce new features. A huge cost curve or learning curve that brings them forward. These are the classical Lollapalooza effects that Charlie Munger loves so much. Who could have imagined that salmon raising has become big data business? One of the Norwegian companies does face recognition for salmon. You know, hello, dear salmon. Hello, Knut, how are you today? You're not feeling well. Swim right. We have more vitamins for you. Oh, you're doing well. You left no antibiotics for you today. I went to a farm about 2 or 3 years ago, and they said up to recently we didn't know if all our cows were there. Now they get chips, and you know what the temperature, the body temperature is, what they need, if a new calf is underway, if the milk needs additional content. Even animals have become big data. And if you ignore that and stay traditional, you won't see the changes that are coming. This is another one. This is the Impossible Burger, which you all heard about. Our nutritional system is changing. A cow needs 25 kilos of feed to develop 1 kilo of meat. If you go to a chicken has 2.5 kilograms of feed to get 1 kilogram of meat. And in a vegetarian burger, you have 1-to-1. It's much more environmentally conscious to have vegetarian burgers and as a meat replacement. And if you stay with the tradition, this is the future. We cannot feed the world without this technology. And a third example, out of many examples, the electric engine. A traditional German-made combustion engine with a gearbox costs about 5,000. Weighs a couple of 100 kilograms. This one costs $1,500 US, weighs much, much less, 83 kilograms, and it's much less complex than a combustion engine. Much easier, and if something is easier, it will change the world. It's a Japanese company, Nidec, one of the key suppliers in the automotive industry of the future. That's how we think about the new world of investing. We sat down in our team and said, what are the basic human needs? It's nutrition, it is mobility, it's communications, energy, health, accommodation, shelter, consumption, and financial safety. What are the new technologies that are coming? We need new protein sources. We have indoor farming. We have genetically modified food, etc. And what are companies that are active in that field and are developing the stuff that we need to be there. So we went out 5 years into the future, actually 7 or 8 years, said who will be the players 7 or 8 years from now, and said we want to buy these companies because the world will come to us, we don't have to search for it, it will come and follow our thinking if we are right in our reasoning. So I want to ask you all to be more daring, be more forward-looking, expand our and your circle of competence. If something is new to me, learn about it and change from a find mode. We will screen and we will find companies to a search mode. Which is the company that will be the prominent player in a certain field, and find those and search for those companies that will be the game changers for tomorrow. And it's still value. It's a slightly different time horizon. It's more optimism, more forward-looking, but it's still value, and our discounting models are still the same that we've used for all the time. Thank you.
So if we can do some maybe some Q&A, some questions for Dr. Leber. Yeah, we have one over here.
I have a question for you. If we look at cyclicality, the cycle going on, its value doesn't mean that we doesn't look for technology and for improvement in technology and in moving forward. And value also take into accounts the result of the company. And so the process of value investing in the way you laid out is being pessimistic about the evolution. Instead, I think that value investing is optimistic on the asset that will gain value in the future because their perception is undervalued, which is something different. So my question for you is, in this model, how are you doing to find value in, for example, because you spoke about Tesla, if you look Tesla to the numbers of cars they sell and the things, they look overvalued.
Yeah, I don't like them at all. We don't have them.
Okay, then my point is, in specific industry, you should always compare the one that are increasing the value and their asset. And so you might have, in different type of industry, you will always come with the one that are cheap and the one we are expensive, related to the results.
Yeah, you don't have to. One example, cybersecurity. I think it will be one of the big things coming in the next couple of years. Your cyber attacks all over. We just don't see them yet. They're already there. And we looked and we didn't find any value creator there. It's a highly competitive field and there's no way to make money. In the automotive field, we just looked at the whole value chain. We started at the lithium production, went through the cathode production, to the separator foils, to the battery makers, to the recyclers at the end, to the power circuits, and looked who in that value creation or supply chain is the one who is gaining most. We have one car manufacturer in there, which is BYD, but that's about it because they also make batteries. So look at the trends, find where is actually the value creation taking place in the whole supply chain. And the second point that you mentioned, of course, this is also cyclical. You have phases where things are hyped, then phases where this hype won't come, then it will come again. So yes, of course, you have to play the cycles. You have to look where the value is created and not by the most obvious example. But one thing is that when things revert to the mean, do they do it on an upward slope? So is the curve, the overall curve going up? Or is it in a sideways industry like the steel industry where, I don't know, I mean, you have cycles and in the best case you get back to the previous level, but it won't be 10% or 20% higher than in the past. So look for the cycles, if possible, in an upward trend. I looked at sport shoes. We wondered, why is Nike such an interesting company? Are they better than others. It's just a 20-year cycle of people using more sport shoes, and Nike is just one part of it. So look at the overall development. People will wear more and more leisure shoes overall, and then pick one of them. It's Nike, Adidas, whatever, Asics or whatever. But I like to understand the underlying trend first, and then look at this winners and losers in the game, and then the cycles in it. I hope it helps. Not convinced?
Any other questions?
One important element in value investing is margin of safety. How do you deal with that in your way of looking at investing?
Yeah, we have always used a discount rate of 10%, as Warren Buffett does, even now that the interest rates have gone down. We do have 1/3 of the company still has a margin of safety. We use the valuation model is called the Penman model, Professor Stephen Penman, which we use for all the companies in our universe, which is basically the use of capital, the return on the consumed capital. We take out all the financial side of it, discount, and try to model it over maybe 10 years and then go into a steady stream. So we do this for all the companies that we are investing in. And the margin of safety is disappearing for some of these companies. What we then do is try to find the implicit rate of return. So we revert the whole calculation, and we usually come out with rates of return of 6 to 8% at the worst, and 12% for companies like Brookfield Asset Management, for example. So the old margin of safety is gone for some companies. At 10%, it is difficult to find companies with a margin of safety. If I look at the internal rate of returns, especially of some of these steady performers, I'm still happy at 6% internal rate of return compared to the rest of the world, which is yielding much less. That's our approach. I don't want to play around with the discount rate, because that, as soon as you start playing around, it becomes meaningless.
So I think we have to continue to the next speaker.
Okay.
So I'd like to thank you, Hendrik.